Hello and welcome. My name is Benoit Poliquin. I'm the lead portfolio manager on the EIM Partners Fund, our partners fund here at Exponent. And as an investor, I figured I'd go through the year-end report carefully and try to expand a little bit, since this is a new fund, on and how our capital was deployed. So the number one thing, so here's a report for the end of December, and you obviously can download this from the website. So number one to remember is you can see a different weights on the left side. So then how I like to establish positions typically is I want to own 2.5 to 3%, and that what I consider is a full position. I will have overweight positions, which are closer to, let's call it 3.5 to 4.5 or even 5.5% positions. Those are overweight positions, usually because they're stocks that I find, or we have found as a research, to be unfairly punished. And then finally, what we're going to see are trading positions, which are small positions that very short term in terms of trading commitment. And so the core positions, the 2.5%, a lot of these positions are really things I feel we can own for 2, 3, 5 years at least. And the trading positions can be a few months. And obviously the half positions are positions that I would like to become core, and eventually will add to those positions on weakness. And for the larger overweight positions, eventually they will come back to the usual core weights, if you will, at 2.5 to 3 positions. But because the stock is so unfairly punished or so cheap, I'm happy to overweight it for a period of time. And so effectively, as you track what's going on in the portfolio from month to month, I would suggest that you look at the weights. The next one is obviously the short-term performance, which is obviously a dicey situation, because sometimes I will put in positions and it'll take some time before they actually gel or happen. So they'll be, or in terms of core positions, I've accepted that I will have volatility to those positions. So something like CNR, which is down almost 4% for the month of December, we're up almost 22% on it. But these are positions that I want to own for the very long term. And so essentially, let's talk about how the company or the capital was deployed. So if you go back in history, you can see that the initial capital, really life in terms of the fund, happened in late June. So the challenge here is the markets. Late June, and the market was flatlining. There was a lot of worry economically, and the markets had been basically flat for a while, and there was a high expectation of either higher interest rates or an economic slowdown, and so on and so forth. And so the investors were kind of very leery, and so we had to deploy in a hot market that was basically that had gone up substantially since the beginning of the year. And so there was certainly, it would have been a normal event to have sort of a pullback, and frankly we were expecting a pullback, and it really at all didn't happen, or it happened but much later. So the market, and that's the thing about market timing, is that it's very difficult to do and to be right. So what we manage in the marketplace, in the S&P 500 anyway, and the TSX is a little similar in terms of movement, continued all the way till September, and then sold off substantially, and then finished the year very strong. So how did we manage that position? Well, the first thing that we did is we received substantial capital, and then the next thing that we did is we started selling puts, or basically buying stocks that we wanted to buy, but we were setting prices that were lower than what the prevailing markets were. So effectively, we were collecting option premium, which is capital gains, and we were waiting for our price. And if we were going to fill, most of the positions are 10 or 15% prevailing rate. So if we were going to get or buy these stocks, we were happy to get them at the said prices. And so as we move forward in time, we eventually And on weakness, we would add to the stock. So initially, when you'll see the activity level, that's what you see when you see expiry. You basically see the puts coming due or ending their lives, if you will, or coming due in terms of calendar-wise, and the fund keeping the option premium. So all in all, the capital gains realized in a short period of time, basically 6 months, was in Canadian dollar terms about $750,000. So from a trading perspective, the account did very well. The challenge really was trying to set the positions that we wanted and still want at the level that we did. So what we did is during the sell-off, we started buying more and more. So you will see our activity level sort of increased as market weakness happened. And so what does I mean by that? So basically what we've had is we now have basically a fully deployed account. Rather than stay in cash, we overweighted the positions that were cheap. And the rate of return for the fund itself is, for 6 months, actually pretty good, especially considering the fact that we had, a lot of cash for a lot of long time in terms of the year. So let's look at the performance for a minute. Before I do that, I also want to point out that for about 6 months, we collected about $240,000 Canadian in terms of dividend income. So the income received in the fund is actually quite substantial as well. So let's look at performance. So since the life of the fund, the account is worth 2.41%, which is obviously pretty weak when you compare it to the different benchmarks. But I hope that you appreciate that the short-term performance, the 3 months and in, has accelerated substantially. So when you're looking at the performance from month to month, you want to compare the account or the fund versus the markets, and you want to do that in either in up markets or down markets. Typically, we'll do less well when the markets are running, and because that's usually when we hit our target prices, we'll tend to sell, and because of the discipline, we tend to sell early. And conversely, in down markets, we tend to buy. Sometimes we buy a little earlier, what we're trying to do is capture less of the downside. So what do I mean by that? So if we look at monthly sort of returns, let me show you in a minute what we're trying to capture here. So you can see that June, July, and August, there's not a lot of appreciation just because the account, we're selling puts, we're collecting a bit of money, but the markets are just running. And so we tend to not want to chase markets. As we got some softness, you can notice that we're capturing some of the downside, but not as much as the market. And really, we're buying into this weakness. The market bounced back in October, and we continued to buy. And then finally, the portfolio gelled in December, and so far in January, things are looking well as well. So effectively, we had, it took us about 3, 4, 5 months to really get the portfolio the way we want. There's still some names that we would like to own, namely the Canadian banks are an obvious one, and we put half positions, and on weakness, we will add more to them. The themes of the portfolio, you can see energy, so both the dinosaur bones are the conventional way, but also renewable energy. You will see companies that solve problems, so 3M comes to mind. We're also looking at companies that are getting exposure to leisure, especially in the American markets. We want exposure to leisure, either leisure travel through Alaska Air, which is effectively a gateway into Hawaii, or you're getting leisure trades in terms of whether it's RVs, motorcycles, recreational boats. So really, and because there's a lot of volatility within those leisure names, we've decided to sort of take a broader approach. There is an overweight names in something like Scott's Miracle-Gro, and the other would be Disney or something like Logitech, which those stocks have suffered, in our opinion, unfairly, and so we're happy to overweight them as they come down and as we add to them. So that's effectively what has happened in the portfolio. Overall, I would say that, in terms of the other way to look at this portfolio is to see, okay, well, what we refer to them as torpedoes. Is there any sort of stock in here that is problematic? So that would be a stock that would be down 20% plus from the purchase price. And as we move down, we have, well, this is a small spin-off, so it doesn't really count. But basically, as you move your finger down the line, you really don't have any sort of torpedoes. The argument can say, well, Ben, the market's been up, basically up in the straight line. That's true. But as we move into January, we feel we're well protected because a lot of stock that we did get exposure to were stocks that were already kind of beaten up. And so we don't find that the downside is as great as many other names that have actually done quite well, but we just didn't want to chase them up. And in a nutshell, that's what's transpired in the account. So overall, the account is done. We're quite happy with the performance of the account, considering the conditions that we've had. We've had some nice realized capital gains. We have some really good dividends coming at us for the near future. And so I think that's the update. If you have any questions or comments about the fund, we would certainly invite you to write in and let us know what you think. Thank you so much for watching.